Good morning. This is Peter Miliash from the Finance News Network. The stock market was divided Tuesday as investors struggled to keep building on early 2023 momentum and weighed the latest earnings results. The Dow Jones Industrial Average lost 1.1%, the Nasdaq Composite rose 0.1%, whilst the S&P 500 fell 0.2%. When assessing the S&P 500 sectors, they were mostly mixed. Leading the way was information technology, energy and real estate, whilst materials and communication services lagged behind. About 7% of the S&P 500 have reported earnings through Tuesday morning, according to FactSet. Of those companies, 70% have beaten expectations. United Airlines will report its quarterly results after the bell. Wall Street is coming off positive back-to-back weeks to start the new year, but investors may have entered a hall of mirrors, according to Mike Wilson, Chief US Equity Strategist at Morgan Stanley. The rally this year has led by low quality and heavily shorted stocks. However, it's also witnessed a strong move in cyclical stocks relative to defensive ones. This move in particular is convincing investors they are missing something and must reposition. Year to date, the Nasdaq Composite is leading the way, up 6%, as investors bought beat-up technology shares amid rising hopes of an improved landscape for growth stocks. The S&P 500 and Dow have advanced 4% and 2% respectively since the start of the year. Gains have come on the back of the first crop of inflation-related data that investors saw as indicating a contradicting economy, with hopes that will give the Federal Reserve justification to slow interest rate hikes once again. Last week, the Consumer Price Index for December showed prices cooled 0.1% from the prior month, but prices were still 6.5% higher than the same month a year ago. In company-related news, Goldman Sachs has slid 6% after the bank reported its worst earnings miss in a decade for the fourth quarter. Its results were pressured by declines in investment banking and asset management revenues. Meanwhile, rival Morgan Stanley posted better than expected numbers, thanks in part to record wealth management revenue. Its shares have jumped 6%. Those results came after other major banks such as JP Morgan and Citigroup reported mixed quarterly results. Bank of America's latest Global Fund Managers survey said managers are less bearish than in Q4 given the optimism from China and the Fed, while recession fears peaked in November. Cash levels dropped 0.6 percentage points to 5.3%, the biggest decline since June 20 amid rotation into emerging markets and the Eurozone. The shift came at the expense of US stocks, which were the most underweight since October 5th, which was on record a 27 percentage point increase in net underweight. They also said US rotation is in part driven by the move out of technology stocks, which remain an outside drag on US markets. When assessing the long holiday in the States, there have been some significant themes. Companies are pulling back on price increases in response to some backlash from wary customers. Another sign inflation pressure may be easing. Despite the negative revision trend, strategists concerned consensus earning estimates for 2023 are still too high in the face of recession risk. While soft landing hopes have picked up a little bit, there is still no shortage of headlines about how economists and chief executives believe a US and global recession are likely this year. And to Australian news, the Treasurer's worst-case scenario for gas prices have become a reality, as the prices have soared 30% in Queensland and 22% in New South Wales over the past year. And to make matters even worse, retailers are expected to raise prices by an additional 20% starting from next month. Energy Australia stated on Tuesday that its residential gas customers in Victoria would see their bills increase by an average of 26.7% from February the 1st, whilst Origin and AGL last week said their rates would increase by 22% and 21% respectively from the next month. The SPI futures are pointing to a 0.2% gain. Thank you for listening.